Fred Pacelli here. So today I want to talk briefly about 3 things that may trigger an IRS audit. These are the 3 main things, in my opinion, that are most likely going to trigger an audit for normal everyday taxpayers or business owners. So the first one we're going to talk about is unreported investment income, dividend income, or interest income. So normally the way this works is if you're investing in a brokerage or through a brokerage at a place like Charles Schwab, Fidelity, Vanguard, they're going to be paying you some form of dividend, some form of interest, or if you've had any, capital gains throughout the year, that's the brokerage that's going to be paying that to you or where you're going to be recognizing those gains. So on the flip side, basically what's happening is at year end, they are going to issue a statement to you. That's going to be a 1099. And then they're also going to issue a statement to the IRS. That's going to be, so the IRS is going to have a 1099 and you're going to get a 1099. The IRS is then going to see how much income you should have reported from that brokerage and then match it to your tax return to see how much you actually reported. If there's discrepancies, that's most likely going to trigger some form of an audit. The second one is going to be a supplemental income not reported. So it's going to be very similar to the investment income or dividend or interest income we just spoke about. But basically it's going to be if you were 1099 from some sort of contracting work, if that entity that 1099'd you reported that income to the IRS and also sent you a 1099, but you did not report it on your year-end tax return, the IRS is going to match that as well. So they're going to see, hey, so-and-so should have reported $5,000 in contracting income that they earned from XYZ company. If you don't report that, then that's going to be a wage mismatch and they're going to flag you right away. It's most likely going to issue some form of correspondence audit where you're going to have to pay penalties or fees for the unreported taxes or income related to that 1099. Now the third one I want to talk about is for the small business owners. This could be its video of its own, but basically what this is when you're doing a Schedule C or a 1120S or any type of entity, you're going to put in a industry type. So when the IRS is going to begin reviewing some of these tax returns, if they're selected for some preliminary review, they're going to compare deductions, revenues, and types of deductions among the same service line and compare it for consistency purposes. So let's say you're a marketing company. If you're a marketing company and you're deducting maybe $50,000 in rent, but you only have $400,000 in revenue. If they're seeing that you're the odd one out, other marketing companies that have $400,000 in revenue are only maybe doing $40,000 or $30,000 in rent. They might do some form of follow-up to at least see what makes up that rent expense. So what's basically going to happen there is they're going to inquire, they're going to ask for some supporting documentation, and then they're going to see what makes up that line item. Now, if they don't like what they see, it could start to unravel and they could start to look into more things. So basically what you want to do is make sure everything is consistent, you're not over deducting, everything stays within reason.